Today's market action wasn't just about geopolitical headlines from the Middle East. A key driver was an inflation signal hidden inside the ISM manufacturing report. The ISM manufacturing PMI came in at 52.4, signaling expansion in the factory sector. However, traders focused on the prices paid index, which surged to 70.5, the highest level since mid 2022. This indicates input costs were accelerating even before the weekend spike in oil prices. Executives cited new 10% global tariffs as a source of cost pressure. Taken together, these details suggest inflationary pressures may be building from structural trade dynamics, not just temporary energy volatility. Stocks fell early as oil jumped and the 10-year Treasury yield approached 4%. Markets recovered much of those losses midday, led by institutional buying in mega cap technology. Nvidia rose nearly 3% after Morgan Stanley named it their new top chip pick, describing the setup as a compelling entry point. This rebound reflects liquidity supporting AI leadership stocks despite rising inflation risk rather than panic selling. Energy and defense stocks benefited from geopolitical tension. There was also a quieter trade in domestic steel producers like Nucor and Steel Dynamics. Rising input costs combined with tariff protections help support margins for these companies. When global costs rise, firms with pricing power and structural advantages often outperform, making this a strategic trade rather than a headline driven move. Today reinforces that inflation shadow is real. Investors should monitor oil prices, the 10-year treasury yield, and whether mega cap tech continues absorbing volatility. If inflation data continues surprising to the upside and pushes rate cut expectations further out, volatility that looks contained today could broaden. This is effectively a liquidity test examining whether the AI driven rally can hold in a higher for longer interest rate environment. If yields break higher and tech leadership weakens, that would suggest inflation pressures are beginning to challenge the current regime. If liquidity continues flowing into AI despite higher rates, this episode may remain a contained volatility event rather than a structural shift.